If you've saved £180,000 in a stocks and shares ISA, you might be wondering, how much retirement income can it really provide? The answer could surprise you, and it might be more or less than you think. Welcome back. Today we're diving into one of the biggest retirement questions. How much income could you generate if you've built up £180,000 in a stocks and shares ISA? We'll break it down in simple terms so you know exactly what that money could mean for your future. If you've built up £180,000 in a stocks and shares ISA, one of the biggest questions you'll face is how much retirement income this could realistically provide. With the cost of living rising and pensions often not stretching far enough, many people are turning to their ISAs as a vital part of their retirement plan. But the answer isn't as simple as one fixed number, because the income you can draw depends on several important factors, like withdrawal rates, investment performance, inflation, and how long you expect your retirement to last. The stocks and shares ISA is popular because it allows your money to grow free of capital gains tax and income tax. That means every pound of income you generate from it stays in your pocket. If you have £180,000 saved, the question becomes, how much of this pot can you safely draw down each year without running out of money too soon? A common rule of thumb used by financial planners is the 4% rule. Applied to £180,000, this suggests you could withdraw around $7,200 a year. That works out to about £600 a month of tax-free income on top of any state pension or workplace pension you receive. However, the 4% rule is just a starting point. Some experts argue that in today's world of market volatility and rising inflation, a safer rate might be closer to 3.5%. That would give you around £6,300 a year, or about £525 a month. On the other hand, if markets perform strongly and your investments grow faster than expected, you could potentially withdraw more without depleting your ISA too quickly. It's all about balancing growth with sustainability. Another approach some retirees take is using their ISA as a flexible backup rather than their main source of income. For example, you might rely mostly on your state pension and a private pension, and then dip into your stocks and shares ISA during expensive years, such as when energy bills rise or when you want to travel. In that case, the £180,000 could last you much longer, possibly supporting you throughout a 20 to 30-year retirement. It's also worth thinking about investment strategy. If you keep your ISA invested in a balanced portfolio of stocks and bonds, you may continue to see growth even as you withdraw money. That growth could help preserve your pot for longer. But if you move everything into cash, the money will be safer from market swings, but will likely lose value over time due to inflation. That makes it important to strike the right balance for your risk tolerance and needs. Ultimately, £180,000 in a stocks and shares ISA can provide a meaningful boost to your retirement income. At a moderate withdrawal rate, you could expect between £6,000 and £7,500 per year, all tax-free. Combined with the state pension and any workplace pensions, this could give you a more comfortable retirement. The exact figure will depend on how you manage withdrawals, how your investments perform, and how long you need the money to last. For many retirees, the key is flexibility, adjusting withdrawals when times are tough and preserving the pot when markets are strong. Thanks for watching. If this video helped you understand how your ISA could support your retirement, don't forget to like, share, and subscribe. Hit the bell icon so you never miss important updates on pensions, savings, and retirement planning.